talk a bit about ARR financing and non-cash flow financing. That stuff looks really vulnerable.
And sticking with software loans, a group of banks led by JP Morgan halted a $5.3 billion debt deal for software firm Qualtrics International. That's after Qualtrics failed to win over investors as deepening anxiety surrounding AI disruption persists. Bloomberg News reporter Aaron Weinman has been covering this story and joins us now. Aaron, this AI anxiety is prevalent in public markets and clearly in loans as well. Just how much is it stymieing deal activity?
So I think it's a tale of sort of haves and have-nots. In the case of Qualtrics, JP Morgan and a group of banks attempted to engage with investors last month, and basically what's happened now is investors really like EA, so EA is the focus right now, and it's a lot larger, but Qualtrics is expected to sort of come back into the vision of investors in a few weeks' time. So they've effectively put it on the back burner because Qualtrics' existing loan in the secondary market has been taking a hit.
But didn't they also change the dynamics of the EA debt deal too?
They did, yes, they did. So what they've done with the EA debt deal is they've shifted the bonds and loans portions. So initially the talk was that it was going to be more loans, but now there's quite a large bond portion. To your earlier point about software, what you've seen is that there's about 15 to 17% of software-related credits in the leveraged loan market, and that's sort of been bringing the index down. Qualtrics has been hit by that,
right?
And so that is why there is effectively a move by the banks to delay that and come back in a few weeks' time and re-engage with investors. And I guess the hope would be to launch the deal
hopefully
at that time.
Aaron, thank you so much for joining. Appreciate it. That's Bloomberg's Aaron Weinman. Up next, it's our investment committee. World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's Deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Scarlett Fu, who's taking a closer look at regional banks and the state of M&A. Scar.
Well, there has been some deal making in this sector, but not necessarily to the extent that investors anticipated in the lead up to the second Trump administration. Regional bank shares, they are slightly higher since the 2024 election, even with Trump regulators being seen as hands-off in contrast to Biden's more aggressive approach to antitrust. Now, recent deal making includes PNC agreeing to buy First Bank for $4.1 billion in September, Fifth Third buying Comerica for $10.9 billion a month later, and this year, Spain's Santander acquiring Webster Bank for about $12 billion, while both First Horizon and KeyCorp have signaled that they may pursue some deals. According to Herman Chan of Bloomberg Intelligence, higher valuations are one reason why M&A has cooled. You can see how the S&P Regional Bank Index's price to tangible book value has steadily risen from the low in 2023 following the collapse of Silicon Valley Bank. Boards have less incentive to sell when their shares are trading at these elevated multiples, with earnings outlooks improving for many banks thanks to solid loan growth and expanding net interest margins. Potential sellers may feel more comfortable staying independent, and as a result, Danny, less pressure to have to do a deal.
Scarlett, thank you very much for that context. A big day on Bloomberg Deals here for FIG investing, and that brings us to this week's Investor Committee, where we take you into boardroom debates in real time. Today's theme is the banking sector M&A, and joining us, today's Investment Committee, it's Randy Payne, President of Key Institutional Bank, Angela Strange, General Partner at Andreessen Horowitz, and Amit Garg, Senior Partner at McKinsey. Thank you three so much for joining. Randy, let me start with you. For this sector, where are the most attractive targets right now?
Yeah, I think as we just heard, we've seen an uptick in bank M&A activity, but I would characterize the environment as normalizing. You know, there was very little M&A activity under the previous administration. It was taking a year to 2 years to get things approved, and that's come in quite a bit. You know, it's a fraction of that time now. For KeyCorp specifically, it's not on our priority list, but in terms of other depository deals. But you know, we're very active in terms of just tuck-in knowledge-based businesses. We've bought some investment banks and done that very successfully. I think more broadly, lower rates are going to help fuel more consolidation, whether it's in the insurance space, fintech, and we are seeing that.
I'd be interested to get your take on it. I mean, is it the big deals or is it these more kind of like tuck-in things? Where in the space is the most attractive now?
You know, our view is that historically the big deals haven't really done the returns that everybody expected of them. So where the world is heading is what we define as precision M&A, which is about tuck-in transactions that add capabilities or extend the business into new business segments where there are attractive returns like wealth management, or really filling the gaps in your portfolio, certain markets where you're underrepresented or you don't have the right scale in certain other markets.
Angela, I'd love to get your take on this because obviously you're coming from a different part of the world, more startups, that VC type of nature. What would be your pitch to the investment committee? Where do you think is most attractive?
Yeah, listen, A16Z invests across all areas of the economy. I've spent the last decade in fintech and financial services, both at the very earliest stages and the latest stages. And the way we think about it is every technology product wave creates a whole set of opportunities. As you look at mobile cloud, that brought us the neobanks, it brought us payment companies like Ramp and Stripe, and we're just at the start of AI, which is by far the biggest wave yet. And so I think we see a influx of new companies that are going to be competing with the banks. We see a lot of companies that are selling into the banks to help them become more AI enabled. And both of those categories are going to be very successful.
Can you put some more color on what those categories look like, Angela? What type of companies are the ones either doing the disrupting or getting bought by banks?
Yeah, we think there's a lot of activity in maybe 3 buckets. The first would be described as software augments labor. And so if you think of a specific example, usually banks would buy a software and then they would have to hire sometimes thousands of people to then operate it. Compliance is a very good example. And I'll use one of our companies, Sardine, which sells transaction monitoring. And usually you would buy this software and then you'd have thousands of L1 compliance officer doing research into all of the alerts. Now the software does the software and also a lot of the labor around it. And so you can think of, you can't hire enough compliance people fast enough, you can't train them. Every one of these minor tasks takes 15 to 45 minutes. That can now be accomplished with AI. And all of that is happening across various areas of the bank.
Randy, how are you thinking about deal making in terms of at KeyBank bringing in AI capabilities via purchases, via acquisitions, or growing it internally? How does that outlook appear to you?
Yeah, all the above. AI is going to be a game changer for banks and certainly KeyCorp. We really think we're in the sweet spot because we're big enough to make big investments in this area. We're going to spend $1 billion on tech investment this year, up from $800 million in 2024. But we're also small enough to deploy it at scale and do it quickly. And so we think it's going to be, just as you heard from Angela, a way to make for a better employee experience, a better client experience, as well as provide huge opportunities for us to get more efficient.
Are you doing a lot of work here when it comes to AI enabling of various banks?
Absolutely. This is the topic that banks are really interested in. They are seeing real tangible benefits emerge. I think a year ago we were talking about AI as lots of experimentation. Now we see our clients really deploy AI at scale for both their client benefits and candidly to operate better and more efficiently.
I feel like we have to talk about some of the risks of M&A getting done in this sector. Randy, you're pointing at me being like, yeah, I feel like there's a big one out there, which is market volatility, concerns about war. How is that impacting your look ahead?
Well, I think if you think about bank investors, specifically regional bank investors, they really aren't all that bullish on M&A. They'd rather see banks, increase dividends, pay out, make higher levels of share repurchase, or invest in organic activity. And that's why we have really, said we're not focused on bank M&A. But the other reason is for just what we talked about. M&A is highly distractive, and it's not without risk, the execution risk. And when you're talking about deploying this incredible technology across, scaled enterprises, we'd rather be focused on that.
Angela, I'd love to get your take on that. What do you think of that risk, that some of these things might act as a distraction and banks want to focus in on the core?
Now I've got a strong agreement with Randy. Listen, banks spend $650 billion globally on technology, but 70% of that has historically gone to just maintaining systems. And the view has been it's too risky to replace them. This is the year where the risk of not replacing them is going to outweigh the risk of replacing them because the new systems are just so much better. For instance, now in mortgage servicing, usually you can get 750 loans per employee. The new systems will get you 3,000. Then the companies think they'll go up to 10. They can reduce your time to get a mortgage from 40 days down to 20 days. So often M&A is helping you grow and become more efficient. Now with AI and technology, you can accomplish the same thing even better.
There is some tension in there, though. Do you do these things? Does it maybe risk a distraction, or is it necessary? Amit, where do you fall into this?
I think it is necessary. If you don't disrupt yourself, you get disrupted. So I think we see that, yes, there is execution risks when you do big M&A, but if you don't actually invest in the right technology to continue to improve yourself, you get left behind.
What do you think for where we head in 2026? We started this conversation, Scarlett, saying all of the deals that have been done, we've had the big purchasers come in. I mean, let's expand beyond KeyBank itself, but the overall market, do you expect there to be a lot of deal activity in FIG, in financials this year, Randy, or do you think it might end up being more muted?
I think it's going to be a normalized environment. Certainly, a regain of more bank M&A, but I don't think there's any catalyst, and I really think that buyers are focused on how they can transform their business, with the deployment of technology, and that's a huge opportunity as we've been talking about.
All right.
Yeah, no, I think it will pick up. Even if you look at the price to book of the banks, yes, we are normalizing, but it still operates at a fifth of what the tech sector is, or a third of what the industrial sector is. And at 1.5 price to book, there's still a lot of differentiation in the market where we'll see M&A pick up.
Angela, let me get your thoughts on this. Not only on where volumes look, but I'd love for you to comment too on how valuations stand for the industry at the moment.
Listen, I think that banks are very much leaning into AI in a way that we haven't seen across any of the other technology sectors. And it not only improves their efficiency, but also enables them to scale and serve a lot more customers. Like if you think of AI as a horizontal, you now have an army of infinitely patient, knowledgeable, available employees that work 24/7. And so you can hire you couldn't hire before. And you can also enable all of your employees to be more human Do you want your wealth managers out talking to customers, or do you want them in the back office doing paperwork? And so I think we're going to see the companies that lean into this technology the fastest scale much more quickly, and valuations will come along with that.
Angela, thank you so much. And thank you to everyone in today's investment committee. That's Randy Payne, president of Key Institutional Bank, Angela Strange, general partner at Andreessen Horowitz, and Amit Garg, senior partner at McKinsey. Up next on the show, private credit on pins and needles as investors assess the impact of risks of software, of volatility from the war in Iran. We're going to discuss all those risks and the state of M&A with Rob Brown, the CEO of Lincoln International. You are watching Bloomberg Deals.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? Do you ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round or the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're just about halfway through the trading day in New York. I'm Norma Linda. Let's take a look at your midday movers. First up, oil is surging as Iran pledged to retaliate after Israel attacked a key natural gas field. At the same time, Bloomberg News reports Vice President J.D. Vance and other key Trump administration officials plan to meet with oil execs tomorrow as the White House looks for ways to tame surging fuel prices. And U.S. stocks are under pressure amid the release of a Fed rate decision expected later this afternoon. Over in corporate news, Macy's shares are rising. That's after an upbeat quarterly sales guidance driven by resilient spending from middle and higher income shoppers. Still, the company struck a cautious tone with the full year outlook that missed expectations, reflecting the possibility that tariffs and turmoil from the war in Iran could dampen spending. Meanwhile, shares of Lululemon are higher despite the company's forecast for a second straight year of profit declines. BNP Paribas analysts say that the retailer's guidance had something for both the bears and the bulls. The company said its guidance for the first quarter EPS was likely conservative to make sure the incoming CEO doesn't miss the quarter. And last up, consumers are set to start feeling the impact of the Iran war beyond just price hikes at the gas pump. U.S.-listed shares of Unilever are falling after BASF, a chemical company and one of its primary suppliers, said the cost for its products will jump by 30% or more. Those are your midday movers. I'm Norma Melinda.
A lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them.
That was PIMCO President Christian Strack telling me this morning that private credit loans up for sale right now are pretty bad, though he didn't go so far as to call this a crisis, just said it's a cooling. Our next guest is behind the valuations for roughly a third of all U.S. private credit loans. Joining me now is Lincoln International CEO Rob Brown. Rob, thank you so much for joining. Really wonderful to get you on the show.
Thanks for having me.
So, okay, you have the perfect view on the ground of what's actually happening in private credit. You heard there Christian Strack saying that the things coming up for sale are pretty bad. John Zito warning earlier in the year saying that everything looks mispriced, and then kind of clarify that to say it was just software. What are you seeing? Is this a mispriced market right now?
So maybe back up a second, and you alluded to this. At Lincoln, in our valuation opinions group, we do 25,000 valuations a year. We value nearly a third of every LBO in the U.S. So it is a very statistically significant database, and we have the #1 share in valuing private credit. And part of private credit is this private direct lending, which I think is what everybody's been talking about. And our view, and again, we have access to all the fundamental data. We get down to the financial performance of the business. We know what the credit agreements say. We know what the loans to value are. And when we look at the underlying health of the private credit market, we don't have major concerns. There are some idiosyncratic headlines where fraud was involved. There's been this AI chill of what's this going to mean for long term for some of these loans into the software world. But if you cut through it all, one of the things we look at is payment in kind interest. And when you see that tend to spike, that means that's businesses that can't service their loans and they're starting to pay in kind. And there's good pick and there's bad pick. Good pick is the pick that's done at the time of the loan. Bad payment in kind is that comes in later because you can't cash flow the loans. Bad pick is up. It's up a little bit. I mean, picks, call it 11% of our total database, which means 90% of the loans are servicing the debt. And, if you look at default rates or this kind of shadow pick rate, shadow default rate, as we like to call it, back several years, it was probably 2-3%. That's probably 5-6%. So it is up. But every private credit lender also models in a certain level of defaults, and they model in a certain level of recovery. So there is uncertainty. But as we look at the underlying health of the businesses that are underpinning these loans, we think the headlines are materially worse than the financial health.
Are the headlines worse than the financial health, even when it comes to things like software loans?
So software is an interesting one because I don't think people are necessarily worried about. First of all, if you look at the software company's loans to the value of that company, it's like 30%. So there's a lot of cushion. There's a lot of equity cushion before you get into these loans being with zero. I mean, a lot of these businesses would have to go to zero, and they have to go to zero quickly because these loans are actually being serviced. And if we look at the growth in our underlying database, about half the companies we value had positive EBITDA growth last year. The software were 70%. So I think the fear over the AI chill is, are these companies here 5 years from now? There's not a huge maturity wall coming up for these businesses in the next several years. And so these businesses are throwing off a lot of cash. They can service their debt in the short term. I think the concern, and again, some of the horizontal software companies are at much greater risk. When you look at the vertical software companies, and we're seeing this in the investment banking side of our business, we have lots of software companies we have for sale that are moving forward. There's new software businesses we're taking to market. So I think the risk, the existential risk, is longer term for some of these businesses. And yes, there's going to be some bad businesses that default on their loans in software and other areas. But that's not new. That happens. So I think there is a longer term concern on that. In the short term, we don't see it being the credit crisis that others are making it out to be.
There have been certainly some wobbles in public credit markets and even leveraged loans, kind of the lifeblood for a lot of the LBOs, which Lincoln, of course, takes a very close look at, and you know intimately well. You have this ground level sort of knowledge of it. JP Morgan, for example, not being able to sell Qualtrics debt in the way that they would, rethinking the package of EA loans too. Is there any way in some of these wobbles are actually a saving grace for private credit? How does it change the contouring of how financing is getting done for deal making?
You know what's interesting? When you had SOFR, when you had much higher interest rates and much higher spreads, these private credit funds were getting 12, 13% returns. Well, all this capital flooded into them. When private equity is getting 16 or 17 and private credit's getting 12 or 13, guess what? Private credit is going to raise a lot of money because the risk return is much better. We've had multiple rate cuts. The spreads are down. Now private credit is under 10%. And so, but when it was up that high, there's so much capital that is flooded into private credit and to private lending. That capital's still there. That capital's committed. That capital wants to be spent on funding private equity and leveraged buyout transactions. So I don't see this being a credit crunch issue because there's an incredible amount of liquidity sitting in private equity and private credit that wants to be put to work. And so I think some of what we're seeing is going to affect pockets of this, but do I see a credit crunch getting in the way of funding the right private equity deals? We just don't see that because spreads are still relatively low, which means that this capital wants to be put to work and there's not enough opportunity to put it to work.
Just taking a step back, Rob, these overall M&A markets, they've faced a lot of headwinds. Last year, you get tariffs. This year, still trade concerns, these AI wobbles, and then at the same time, now we have to contemplate the geopolitical volatility of war. How do you see 2026 evolving? Will volumes be robust, or will it be more of a slow and steady year?
Maybe set the context of the back half of last year, because I think you have to look at that to determine kind of what we're expecting this year. There was a material pickup in M&A in the back half of last year. It was clear it was an improving market, not yet a good market or a great market, but an improving market. And generally what you see in the M&A market is volume of M&A follows value. Last year was the year of the mega deal. You had a real spike in the ultra large deals. What we've seen in every kind of recovery of the M&A market is volume follows. So, and we started to see that a bit in the back half of the year. Our investment banking business, which is largely driven by M&A, was up almost 30% last year. And a lot of that was in the back half of the year because, as you noted, we had Liberation Day in April, and everybody thought last year was going to be a really bad year for M&A. It didn't play out that way. It shook that off and picked up in the back half of the year. And why is that? That is because the fundamentals are still good, right? Inflation has gotten under control. There's an expectation of lower interest rates. The underlying economic performance of our economy is good. So with those fundamentals good, with private equity having a backup of deals they'd like to sell, we expected and continue to expect this to be a good, an improving M&A market in 2026. There is no doubt, though, that in the last several months, or last several weeks, we've talked about the private credit.
Injecting some volatility. Rob, apologies, got to jump in, just heading towards a commercial break. Really appreciate your time. That is Lincoln International CEO, Rob Brown.
In case you missed it, on the close.
Of course, tariffs are an issue. But one thing about our company, we see in the next 3 years, 70% of our growth coming from international. So when I'm selling internationally, tariffs are no longer in play.
You have seen some of those European handbag makers raise their prices, that maybe that's given you a little bit more room to bump up your prices as well. Is that something that you agree with?
On a very personal level, I find it offensive that somebody has to save 4 months of salary to buy a handbag. That's not a business I want to be in. I love that you can walk into a Coach store anywhere in the world and buy something compelling, and you don't have to make the choice of missing out on something you would have saved for 4 months. That's powerful to me. So I like our position, and we play our own game.
Don't miss The Close live every weekday.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
We end with a potential sports business shakeup north of the border in Toronto. Joining us is resident hockey expert Scarlett Fu. Scarlett, what are the details?
All right, according to TD Securities, Rogers Communications could sell a chunk of its Canadian sports portfolio to help pay down debt. But this will be a multi-step process because Rogers currently owns 75% in Maple Leaf Sports and Entertainment, which owns the Maple Leafs, the Toronto Raptors, and Toronto FC. It also owns 100% of the Toronto Blue Jays. So according to TD, Rogers would buy the remaining 25% for $4 billion Canadian, combine it with its stake in the Blue Jays and Sportsnet TV channel, and then turn around and monetize that by paying down debt, by selling 30% to private investors.
I got to imagine they could get a pretty penny for that. I mean, sports investing valuations just continue to go up and to the right.
Absolutely. And Toronto is, of course, North America's fourth biggest city. It's got a pretty lucrative and dedicated fan base. And we've seen how MSG Sports has tried to do something similar. There's a pretty big gap between public and private valuations, which is hopefully narrowing a bit, at least in Rogers' case.
It's going to be cool to see how this one prices, Scarlett. Thank you very much. Thank you for joining every day. And that does it for Bloomberg Deals. Stay up to speed. Subscribe to the Bloomberg Deals newsletter. This is Bloomberg.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfil their potential. That's why I got involved in politics and why I got involved in the Labour Party.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
In case you missed it on the opening trade.
This time last year was too optimistic on all counts. So I think, yes, the market's asking for the hyperscalers to show a little bit more proof in the pudding. Last year it was, oh wow, you've raised your capex numbers, you're convinced, I must be convinced. Now investors are saying, I need to see the ROI on this capex before I want you to do more.
Don't miss the opening trade, live every weekday.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Counting down to the Fed against the backdrop of war. Welcome to the Wednesday edition, 1 hour from the announcement on interest rates. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, we're waiting for this news as Iran now threatens to target energy assets in the Middle East. Of course, after Israel did the same, hitting Iran's South Pars gas field. This is why we're seeing crude oil on fire today.
Yeah, well above triple digits on Brent. We're now about $108 a barrel. And of course, when we look at what the Fed is going to be looking at as they make their decision today, we saw producer price inflation already this morning, hotter than expected. And that was before you saw what's happening in energy. So the question is going to be how this energy supply shock filters through into wider inflation. And frankly, is the central bank poised to do anything about it from a monetary policy perspective? Absolutely. Can policy respond to it at all? The administration certainly is trying, as President Trump is now waiving, at least temporarily, the Jones Act.
That's correct. And also calling out the chair while he's at it, asking on Truth Social, when is too late Powell lowering interest rates? Apparently it's not going to be today, Kaylee, and that's going to make for an interesting news conference. We just saw Michael McKee making his way over to Fed headquarters, and he's got his questions handy as well.
Yeah, of course, Chairman Powell's not going to have to answer those kind of questions in this particular forum, at least for much longer, knowing his term is about to expire. But it's still unclear as whether Kevin Warsh is going to be able to be confirmed for the job, as Senator Tom Tillis is still willing to hold things up in that chamber over the investigation into Chairman Powell.
Good thing nothing complicated going on here. It does, of course, bring us back to the fact that gas prices keep rising. It's not just crude oil in the futures market here. We're looking at a national average above $3.80. It's $3.86 in Michigan, where J.D. Vance is today talking affordability, and where, of course, Congresswoman Haley Stevens is from. We're going to be talking with the Democrat in just a moment here on Bloomberg.
Yep, that's coming up shortly. But let's begin with a check on those oil, gas prices, everything else across the board as we turn to Charlie Pellet with the markets up in New York. Hey, Charlie.
Thank you very much. Indeed, 59 minutes to go until we get the latest Fed decision. Jay Powell's news conference, 2:30 p.m. Wall Street time. As you both mentioned, officials widely expected to hold rates steady. Oil, a major story. West Texas Intermediate crude now up 2.2%, $98.30 a barrel. Brent, 108.83, up 5.2%. Crude is rallying after Iran said some of its energy facilities had come under attack and is also threatening retaliation on oil and gas facilities in neighboring countries. Iran has listed energy assets in the region that it will target in response to a U.S. and Israeli attack on its upstream industry. Right now, the S&P is down 47, a drop there of 0.7%. We do have the Dow down 0.9%. The NASDAQ Composite Index down 188 for NASDAQ, a drop there of 0.8%. The VIX at 23, the 10-year ahead of the Fed decision, 4.22%, and the 2-year, 3.71%. A retreat for gold amidst all of this, down 2.4%, 48.85 the ounce, but crude WTI 98.29 a barrel right now, up 2.2%. Brent up 5%, 108.84. Oil majors pushing higher. ExxonMobil up 0.5%. Chevron up 1.3%. ConocoPhillips up by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.